I usually go for a long-term moving average, a medium-term moving average, and a short-term moving average. So I trade using three: the 200 exponential moving average, the 50, and the 20. So I've got a long-term, a medium-term, and a short-term. Moving averages only work in trending markets. And what they really allow us to do when we're doing our analysis is to objectively get a perspective of whether the market's trending. All right, so there's no good using moving averages if the market is ranging sideways. I'll show you some examples a little bit later on about that. Okay, but in this case here, we've got pound versus the Swiss franc, and we can objectively, even if we're not looking at price action on its own, even if we take price action away, we can simply say, just looking at moving averages, that this market is trending because we've got what I just mentioned: order, angle, and separation. So we've got the order of the moving averages in the right way. So we've got the 200 to begin with. Underneath it, we've got the 50 moving average, and then we've got the 20 below it. These are exponential moving averages, not simple. I'll talk to you about why I choose exponential moving averages in a second. But for this reason, it shows us objectively that we've got longer term buyers and sellers, obviously bearish. The medium term buyers and sellers are got a bias on the sell, and the shorter term buyers and sellers, the sellers are in control. So it really just gives us that very objective measure as to whether a market is trending downwards. So we can see alone with the order of these moving averages that it's trending downwards without even looking at the price action, even though I can't really get rid of the price action. So we've talked about the order. If we're in a downward trend, we want the longest term moving average to be at the top, the medium term moving average to be in the middle, and the shortest moving average to be at the bottom. So that's the order. Now we'll talk about the angle. So remember what I said about order, angle, and separation. We have a nice sloping angle here for the 200 and the 50 and the 20. The angle basically gives us the heads up that we've got movement. Like this price action is moving downwards, so of course the moving averages are going to be following it. Even though there's a lag, it will be following it. Of course, if the price action is moving sideways, then the moving averages will be flat, facing to the equivalent of 3 p.m. if you imagine a clock face. But we want our moving averages to be, if you imagine this clock face, tilted in that angle between 4 and 6 p.m. here. So we've got order, we've got angle. Let's talk about separation now. And when I talk about separation, it's also just a confirmation that we've actually got the market doing something, in this case, moving downwards. So separation means that we've got distance between the moving averages, like we've got a good wide distance between the 50 and the 200, and we've got a good distance between the 50 and the 20 as well. So we've got order, angle, and separation. So we go back to our checklist, and I'll just quickly show you what else we need to go to. So we've got order, angle, and separation. Now we want to see what price is doing. Has it tested it before? Well, let's have a look here. I can definitely tell you one thing about price here, and this is thanks to the analysis of the moving averages. It's moving downwards. But here, in the very much the same way as horizontal levels of support and resistance influence or have an influence over the direction of price, seemingly so too do moving averages. And the great thing about moving averages is that they can behave like dynamic levels of support and resistance. What do I mean by dynamic? Well, you've probably guessed it. Dynamic in that they're moving. And this happens certainly when we've got trending markets. And the great thing about moving averages is they can give us a very objective measure as to whether we've got a level of resistance in a dynamic way. The problem with horizontal levels sometimes and trend lines is that they are objective, whereas if we've got a moving average already plotted on our chart for us as a result of a mathematical equation or sum, then we've got objectivity. And certainly when we're in the market, which is propelled by emotions, it's very important we keep our head cool. So this is why I find moving average trading extremely refreshing. So here we've got the first test of this 20 moving average, that it's tested as resistance. It's actually touched the moving average, and then it's gone down, fantastic. We already know the price action is moving down. No prizes for guessing that. So then we get a pullback. And, of course, we've got the market making lower highs and lower lows. And in that, it's cycling. Let me make this bigger for you. So we've got a second test of this moving average. Unlike levels of support and resistance, all we need in our dynamic level of support or resistance in terms of moving average is one prior test. We don't need two prior tests or three prior tests like we would a horizontal level or a trend line. All we need is one prior test. So we've already got it here. So we are on alert now for our potential trade opportunity, as we've already seen before here, that this 20 EMA has actually behaved like a dynamic level of resistance. So we've got price action come to this 20 moving average, but that's not enough. We want a signal to get into the trade, like a price action based signal. It could be a moving average. It could be, a bearish pin bar reversal. It could be a doji. It could be a double inside bar, but we tend to go with bearish pin bar reversals because it's a sign that the bulls have tried to come into the market but have been completely trounced by the bears. So, lo and behold, we have a bearish pin bar reversal. And the great thing about this is not only has it respected the 20 moving average, it's also got a correlation of reasons why it looks so great, because it also, old support here is becoming resistance here. So what we could typically do in this instance is place our orders just like vanilla trading bearish pin bar, bullish pin bar reversals. In this case, a bearish pin bar reversal. So just place our order just below the low of this bar, minus spread, minus the extra pip, with our stop loss above the high, plus spread, plus that additional pip, and wait for the low to be broken. It was. We could target the previous swing low as our first target, take profit 1, and a lower low as take profit 2 for our low probability, high reward outcome. So there we go. It takes a while. There we hit profit, take profit 1, and then take profit 2. We see we're cycling quite nicely. There we've got our phase 1 extension leg here. Then we've got phase 2, the retracements. Of course, markets never go up or down on a straight line. They breathe in and breathe out, just like an organism. Well, not an organism, a mammal, an animal. Nothing ever goes up or down in a straight line, unfortunately. People who've been in a long-term trade will be able to tell you. But that's fine. Absolutely fine, because it means that we can take advantage of key swings multiple times. So what happens next? Well, we know full well at this time that this 20 moving average is a level of dynamic resistance. We've got test 1 and test 2, and now we've made a new lower low here. We've got lower highs and lower lows. We're just waiting for a retracement and then a pin bar reversal off it potentially. Okay, we don't have it, so we are still on alert. There we have it. That's our bearish pin bar reversal. And once again, we've got it not only below this 20 moving average, it marks as a decent entry point to potentially go short, because it's intersecting with the previous swing low, for example. And that's a good entry signal. So then typically what we do in terms of trading it as vanilla price action is to place our entry just below the low here, stop loss above the high, and then our target for a higher probability lower reward outcome is the previous swing low. And then if we wanted to go for slightly higher profit potential, but accept a slightly lower probability, is we go for a new low. And the purpose of this webinar is not for trade targeting, but certainly it's for moving averages. But just to give you an idea as to how we typically target in a trending market. So you can see here that we can use moving averages as not only dynamic levels of support and resistance to validate a trade in a trending market, they're also used to validate a trending market before we've even got to the trading opportunity. So on one hand, they're used for our to help us in our entry signal for a trade long or short, but also to gauge a perspective of the market. So we get triggered into that trade, beautiful kind of move downwards, and then very nice move downwards. I remember I didn't catch the whole move, unfortunately, back then, but decently to get the previous swing low plus a little bit more. Not all the way down there, but hey, sometimes it's damned if you do, damned if you don't.